So let's take a look at the 4 safest investments, again, for savers. Investment number 1 happens to be bank instruments. Now, at Tony Walker Financial, this surprises people. With our Charles Schwab platform, we actually use bank instruments all the time for our clients. We can get money markets, we can get 1-year CDs, and it works very, very good within our process because, again, the retirement planning specialist that controls your money can also make sure that you're getting money to your bank account at the least amount of cost. We just link this up to your checking account and we send you the money whenever you need it. But the key is all the planning that goes into that. So there is nothing wrong with bank instruments. Again, we'll be going over these in great detail next week. The second safe product, and I like these, government bonds. And you might be saying, well, Tony, this doesn't make sense. You're kind of poking fun at all this stimulus money and money flying all over the place and people with mailbox money and all that. How can you say that government bonds are safe? Well, they're backed by the government, folks. Think about this. There's an old saying that says the one that makes the rules gets the gold. So as long as Congress, as long as this government is in charge of creating laws, they're going to back these bonds. Now, granted, it may get into larger tax increases down the road. I don't know, but currently government bonds, and I have a lot of government bonds myself, are a safe place to do business. And yes, at Tony Walker Financial, we sometimes will put government bonds within our portfolios. Number 3, and actually my favorite over the years, one of the safest entities out there, people don't realize this, are insurance companies. The reason I like insurance companies is because they issue insurance contracts. I love contracts because contracts cannot be changed. They're really not investments at all. A contract is 2 people, 2 parties offering to do something for one another. Now with insurance contracts, they're called unilateral contracts, meaning they write the contracts. You don't really have any opportunity to change them. If you accept the contract, you sign off in exchange for their guarantees to do what they say they're going to do, the insurance companies that is, you in turn give them a premium. Now, what are the 2 products we use a lot? And again, personally, folks, just like John Bogle says, I do eat my own cooking here. Personally, I like fixed annuities, and that can be in a variety of fixed annuities, fixed indexed annuities, and immediate annuities. We don't do variable annuities because of the risk associated with them. And then the second type of insurance contract that I absolutely love. It's completely accessible. There's no risk, no fees, tax-free. That's something that most advisors and financial pundits do not understand, and that's something called dividend participating whole life insurance. All right, let's go to number 4. This is one that a lot of people don't understand. They're called dividend-oriented ETFs. Now, ETF stands for Exchange Traded Funds. So what are these? And you might be saying, Tony, this sounds like you're getting into the stock market, partner. I didn't think you liked the stock market. Again, nothing could be further from the truth. Let me reiterate something again. I've been in this business since 1984, all right? I was licensed to sell securities in 1986. I've been around the securities world and the stock market world for a long, long time. I've never had a problem with the stock market. What I've got a problem with is savers putting too much of their money in the stock market and too much at risk. Now, what is a dividend-oriented ETF? And again, folks, we'll go over this in more detail in the coming weeks. But this is a combination of several stocks. You're diversified. And these stocks that we choose within these ETFs can be traded daily. You know, the old growth mutual funds used to be pretty expensive, and they're still around, and some of them are still very good. We just don't offer those because of their expenses, and also a lot of times you can't trade them until the close of the day. Some of you are probably going through this right now. You might have noticed when you tried to move out your 401k to an individual IRA or somewhere else, when you call the company that has it, they'll say, okay, as of the close of yesterday, your 401k was worth X, 100,000. You're like, well, what's it worth today? And they go, can't tell you. We got to wait till the close of today. You may have experienced that. ETFs don't trade like that. They trade immediately, just like a stock. So if you wanted to get out of an ETF, an exchange traded fund, you sell it, you know the value, it's done. Also, you can get ETFs that are focused more on dividends, companies that pay good dividends. So a dividend, by definition, is just a return of profit. So the company, hopefully, these are usually bigger stocks, well-known stocks. Not that any stock can't go under, but basically you're diversified, larger type company stocks. These are the stocks probably that a Warren Buffett would like, for instance. and that they pay dividends so you can have some additional income coming in. So those are the 4 safest places for the 21st century.